Hello and welcome to this Astranti YouTube video on the internal rate of return. We're going to be releasing quite a few of these sorts of videos, ones relating to technical issues, ones relating to various bits of the syllabus, ones relating to the case studies, the objective tests, and also for exam techniques. So if you like this video and you'd like to see more of them, then please hit the like and subscribe button at the bottom of your screen, or visit the website www.astranti.com, where we have many more free samples and also information about the various different products we produce here at Astranti. Now, the internal rate of return is commonly referred to as the IRR. So if you see the phrase IRR in your study texts, in your exam, whatever it may be, this is what they are referring to. And the IRR is the point where the net present value of a product, of a project, whatever it may be, is equal to 0. And so if we look at that on a graph, you can see here on the y-axis we've got the net present value going up, and on the x-axis we've got the cost of capital. And as the cost of capital, which is the discount factor that is applied to a project or a product to take into account the time value of money, as that increases, so does the net present value decrease because it's being more heavily discounted. And the point at which the net present value crosses the x-axis, becomes negative, or it's equal to 0, that is the internal rate of return. And this is generally seen as the minimum return required by shareholders. So if the IRR is greater than the cost of capital, then it is a return better than required by stakeholders. Whereas if it is lower than the cost of capital, then this is lower than the return required by stakeholders. And you should be able to see on the screen what I mean. Any project that falls in this area here is ultimately going to add more value to the organization. Any project that falls into this section here will be adding less value to the organization. And let's explain how to calculate this. And you don't need to know the technical ins and outs of this formula, how it is created, the science behind it, but you do need to be familiar with the actual formula for the exam. And the formula is IRR equals A plus NPVA divided by NPVA minus NPVB multiplied by B minus A. And you may be sitting there thinking, well, what on earth does that mean? Well, it's where A is the discount rate used to calculate NPVA and B is the discount rate used to calculate NPVB. And the procedure for calculating the IRR is to calculate the NPV with the given cost of capital. Step 2 is to use a different cost of capital to get a negative or a positive outcome depending on what the original result was. So if you have a cost of capital that gives you a positive net present value, now you need to use a different cost of capital to get a negative NPV. And once you've done that, you use those figures to calculate the internal rate of return. So let's use an example to demonstrate this. And let's say that we've got a new shop at a company, and this new shop is going to be £600,000 in initial capital expenditure. It's going to have a £525,000 resale value at the end of the period, and the revenues for the 5 years will be 105,000, 117, 120, 150, and 180,000 over the 5 years. And the cost of capital currently used at this organization is 12%. So the first step is to calculate the net present value with that cost of capital. So we've got our 5 years including our year 0 as well across the top here. We know that the capital expenditure in year 0 is going to be £600,000, and we have our various different revenues and also, as you can see, our resale value at the end of year 5 of £525,000. So our net cash flows are as follows. You can see that actually it's just the same as the revenue, except for year 5, where we have the year 5 revenue plus the resale value. giving us a net cash flow of 705,000 in year 5. Of course, we have to use our 12% cost of capital to add in our discount factors. So for year 1, our discount factor is 0.93. For period 2, it is 0.797, and so on. So we add in those discount factors, remembering that there's no discount factor for year 0. And then from that, we can calculate the present value of each year by multiplying the net cash flow by the discount factor. So for year 1, we have 105,000 multiplied by 0.893, giving us £93,770. And repeat the process for all 5 years. And once we have our present values, we can calculate the net present value by adding all those different cash flows together, giving us a net present value for this project of £167,600. So that is our NPVA. Of course, this is a positive figure. So at 12%, it is positive, but we have to have a negative value in order to calculate the internal rate of return. So this time we're going to use 20%. And we've got the same amount of figures here for the net cash flow because everything is the same up until this point. Where the difference lies is in having a different cost of capital. So this time we have to use our 20% discount factors. So 0.833 for period 1, 0.694 for period 2, and so on. So we add in our new discount factors, and then we multiply that by the net cash flow to give us our new present values. So, for example, for year 1, we now have £87,470. For year 2, we now have £81,200, and so on. And once we calculate all our present values, again, we add them together to get our net present value, which this time is minus £6,140. So we have a negative figure for our NPVB that we can now add into our IRR calculation. So let's look back at the procedure and the formula. We now have our A, our NPVA, our B, and our NPVB figures. So we can calculate the IRR using these various different figures. So put the formula back on the screen for you, and also got a summary of the figures on the screen for us. And it's now simply a case of adding in the various different figures into the formula and working through the calculation. So we've got our A rate of 0.12, got our NPVA of 167,600, and we have our NPVB, which of course was 20%, so that's 0.2, and that is minus £6,140. So to calculate the IRR, we work through the calculations. We start by 167.6 minus 6.14, which of course is a positive, so it's 173.74. We deduct our NPVA, or our cost of capital A rate of 0.12 from 0.2, there's a 0.08, and we just continue working through the calculation in that fashion. So 0.12 plus 0.97 multiplied by 0.08. Remember that multiplication comes before addition, so that's 0.97 multiplied by 0.08 plus 0.12, giving us 0.1976. Multiply that by 100 to get the percentage, and that's an internal rate of return of 19.76%. But there are positives and negatives to using internal rate of return. As you can see, we've now figured out the rate in which the NPV is 0. It's 19.76%. So any NPV that is higher than that will have a return of better than 19.76%. And the advantages of IRR is it's very easy to understand. It's a simple percentage figure, that any project that has a return percentage greater than, in this case, 19.76% is a positive return. So anyone can really understand that. It does take into account the time value of money, which we know is a very important thing for an investment appraisal technique to do, because there is a time value of money and we can't assume that £1 million received in 10 years' time is going to be worth what £1 million is today. And it does take all cash flows into account. It takes into account the initial investment. It takes into account every single year. It takes into account the resale value and applies a time discount factor to all of it. And also, it doesn't actually need us to know the cost of capital, because we can figure it out by using two different cost of capital rates. We can use one initially to start with to get a positive result, and then we can use a much higher one to give us a negative result. However, it's not suitable for comparing projects of different sizes because it's a percentage return. And a percentage of return can be confusing when you are comparing projects of different sizes. For example, a 10% return on a £5 project is going to look, in a percentage term, better than a 1% return on a £10 million project. But actually, in nominal values, a 1% return on 10 million is going to be far higher than a 5% return on £10. It can also conflict with the net present value, because it may say, based on the cost of capital, that it's not high enough, or it's not enough higher than the internal rate of return to be taken on, where actually, in theory, any project with a positive NPV should be taken on. So that's a brief summary of what internal rate of return is. And if you have enjoyed this video and would like to see more of them, then please do visit the website www.astranti.com, and also like and subscribe to the video below. And thank you very much for watching, and I hope to see you again.